the reality is that even if we recover quickly from it, relatively speaking, which I have an opinion on, but even if we do, which I don't think will happen, it's still a recession. We're still, regardless of which way you look at it, it's most likely going to turn into a recession. So even if we actually have a relatively strong comeback, we're still probably have 2 quarters of negative GDP. And during a recession, certain things happen. Vacancies usually go up, rents usually go down, and also prices of assets usually go down. The problem is that it takes a long time to discover all that. And so for me, I'm kind of thinking it's going to take 6 to 12 months for me to wait and discover what's going to happen with vacancy, rent prices, and general market prices across different asset classes. So because I'm really low risk, and because when I buy or I invest in something, there's not much padding that we're adding in the strategy. It's a stabilized asset, typically 80 to 100% occupied, and it may or may not have any value add upside at all. I have to be particularly careful with the price that is being paid for that asset, right? Because we're not adding much padding. So for me, if I can't get proper price discovery, or if I think I'm about to buy at the wrong price, if prices are going to go down, I have to be very careful and wait. So for me, this is generally an exercise of waiting, except for some unique pricing or situation that may arise, which can come up, but I'm not really anticipating much happening right now and for the rest of 2019.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. Today we have a special guest named Jeremy Roll of Roll Investments. He's the founder and president of the Roll Investment Group out of Los Angeles. Jeremy manages a group of over 1,000 investors in the U.S. and Canada who seek to passively and manage cash flowing investments in real estate and business. Jeremy is also a co-founder of a nonprofit group called Phoebe for investors by investors with the goal of networking, from learning from, and helping other investors. Jeremy, thank you for joining us on the show. And how you doing, my friend?
Great. Thanks for having me on. Really appreciate it.
I really appreciate you as well. I know we talked several months ago trying to kind of schedule time and finally was able to get connected. I really appreciate it. So I understand you're out in there in Los Angeles. I'm here in Connecticut, where, of course, everyone's hoping to get back to work and stuff like that. But it's a very interesting time. And like I said, love getting your insight, especially you at your experience level. Would you mind just to kind of, for people who are not familiar, especially our audience, talk a little bit about your background, how you got started in real estate?
Sure. Yeah, I'll try to give you the quick version. I'll do my best. So I started investing in real estate passively in 2002 after the dot-com crash. And eventually I rotated all my money from stocks and bonds into what I call cash flow, which includes passive real estate investments. And that got me out of the corporate world back in 2007. So I've been investing in real estate for about 18 years now, roughly. And but I've been full-time out of the corporate world for about 13 years, thanks to the cash flow. So I'm a very big cash flow investor, very big focus on like stabilized, relatively low risk. Like I look for predictability. So my concept is I want to go to sleep tonight, wake up tomorrow, and not much has changed, which we have clearly not lived through in the past month or two. But that's what I personally strive for, just because I live off the cash flow and I always look for predictability. So I kind of have this cash flow snowball, and I'm just trying to get it to be bigger and bigger as the years go on.
Yeah, that's which is very important because, like I said, right now we're seeing a lot of huge dips and flows in the stock market, and people kind of get nervous. But your focus has been on cash flow since day one, and that's kind of like the big key here, and that's what we kind of talk a little about a lot on the show. So your structure of your type of investment model is on the passive side. Are you also a sponsor on certain investments, or are you just looking strictly to work with other sponsors if it makes sense?
Yeah, I'm always passive. I've never been on the sponsored side. For me, because I'm passive, I do a lot of work up front to vet a sponsor and decide if I want to invest with them in that particular opportunity. And then they do the work ongoing after that. Then I'm just constantly verifying, is everything going okay? Is it expected, et cetera. But I've always been passive. So I know a lot about, like, let's say evaluating, apartment deal, mobile home park deal, self-storage deal. I'm in most of the major asset classes, including some commercial and residential, and some other stuff too outside of real estate. But if you ask me to like run a building for a month, I'd be completely in the dark, truly. And I don't know that I'd enjoy it nearly as much as the passive investing side. So this is why I continue to focus on the passive side.
Absolutely. And then you mentioned that because your investment model is focused on low risk, cash flowing assets. Since, COVID-19 past couple months, have your criteria changed, or are you looking at things a little bit differently, or is it kind of the same way and just kind of evaluate it with the same kind of fine tooth comb that you normally do?
Great question. So just to take a bit of a step back. So I've been mostly on the sidelines since late 2016. That's when everything got too expensive for me. So even take a further step back, the way that I invest, because I can actually choose across a lot of asset classes because I'm passive instead of active, I kind of invest in something during a cycle until it gets too expensive. And once it gets too expensive, I've dropped that asset class, continue to invest in asset class and unique opportunities because they're always there, as you know. But I'll then kind of not shift away, but just drop that asset class and continue with the others. So in this past cycle, I found that mobile home parks or mobile home communities were kind of the last bastion of cash flow, and was the last one that people were chasing pricing down on or up. And so by end of 2016, I found those were too expensive. And so I was mostly on the sidelines since the end of 2016, really lobbying my sponsors, so to speak, to sell. I was actually involved in over 30 sales between 2017 and the end of 2019. And in fact, a couple that were in early 2020. And I've been waiting for the market to adjust. That's been my strategy. So we're now at the point where I'm pretty sure it's starting to adjust. And, that process takes 12 to 24 months. It's a slow moving asset. And so right now, if you ask me if I'm investing in anything today, and we're recording this, I think it's in April of 2020, my answer is no, probably not until 2021. And there's two reasons for that. Number one is I expected there to be a much lower volume of transactions in the second half of 2020 due to the presidential election, regardless of the whole COVID-19 thing. Now with COVID-19, what I'm trying to wait for is I'm trying to really discover three different things. Vacancy across different asset classes over time, and what's going to happen in the coming months as this whole thing continues to roll out. My rent prices, which is very different. Like I'm in retail strip centers, I'm in self-storage, I'm in mobile home parks, I'm in apartments, I'm in other stuff. And so each one's got a whole different dynamic that's happening, and there's some commonality, but still there's a lot of differences. So I'm waiting to discover what's going to happen with market prices, and then actual asset prices. What's going to happen with asset prices? Because even though COVID-19 is really hard to figure out because it's a very unusual thing, it's pandemic, it's a shock that is bigger than any shock since the Great Depression way back when. The reality is that even if we recover quickly from it, relatively speaking, which I have an opinion on, but even if we do, which I don't think will happen, it's still a recession. We're still, regardless of which way you look at it, it's most likely going to turn into a recession. So even if we actually have a relatively strong comeback, we're still probably have 2 quarters of negative GDP. And during our recession, certain things happen. Vacancies usually go up, rents usually go down, and also prices of assets usually go down. The problem is that it takes a long time to discover all that. And so for me, I'm kind of thinking it's going to take 6 to 12 months for me to wait and discover what's going to happen with vacancy, rent prices, and general market prices across different asset classes. So because I'm really low risk, and because when I buy or I invest in something, there's not much padding that we're adding in the strategy. It's a stabilized asset, typically 80 to 100% occupied, and it may or may not have any value add upside at all. I have to be particularly careful with the price that is being paid for that asset, right? Because we're not adding much padding. So for me, if I can't get proper price discovery, or if I think I'm about to buy at the wrong price, if prices are going to go down, I have to be very careful and wait. So for me, this is generally an exercise of waiting, except for some unique pricing or situation that may arise, which can come up, but I'm not really anticipating much happening right now and for the rest of 2019. Sorry for the very long answer, but I wanted to at least people the reasoning and stuff.
Yeah, absolutely. And then for people who are, say that they have some cash and they're probably interested, like I said, not a little bit different from you where you said you're going to wait it out a little bit. For people who are maybe interested in this type of cycle, is there any asset classes that are, say, more attractive right now to look into possibly?
Yeah. So what I've seen from the various sponsors I've invested with, because I've talked to a lot of them over the past few weeks, is that the one I can tell you that seems to be holding up really well that I'm involved with is self-storage. In fact, I have an investment in self-storage that in March, all the way through the end of March, was actually up 3.5, almost 4 times net move-ins compared to a year ago March. And there's a couple of very specific reasons for it, and some of it has to do with the location, but some of it doesn't have to do with location. It has to do with people downsizing, moving back home. Maybe they lost their jobs. They have to move in with somebody else, and it's relatively inexpensive for them to take that $100 storage unit, say $100 versus, the rent that they're going to have to pay or the rent they're going to save by moving. So that one has actually held up fairly well. Historically, what's happened in downturns with mobile home communities as a generalization is that the rent prices hold, but they'll have some more turnover than you normally have. But at a lot of these types of parks at the right locations, you'll actually have a waiting list of people who are still interested in coming in. So you get more turn in mobile home parks, but the rents hold well, which is really nice. So you may not get quite as much cash flow, but the rent discovery isn't necessarily a challenge unless this is different this time. The vacancy discovery is a challenge, right? But from a predictability of cash flow perspective, that's not bad. So those two seem to be standing out to me. A lot of the other asset classes, interesting. I actually have investments in RV parks, and I've heard anecdotally some RV parks on the right locations have actually benefited from increased occupancy. Here's some really good examples. These are random, but RV park happens to be very close to a hospital. Hospital staff is afraid, doctors are afraid to go into their family and give their family COVID-19 being asymptomatic for a number of days. They will go rent an RV and actually live in the RV park, for example. So there's been an increase in demand in some of the RV parks in some places. Some people have actually chosen to leave major cities throughout all this, and they'll maybe rent an RV and then go and live in an RV park and get away from it all and not have to worry as much about the virus potentially. So that also I've heard stories about. But generally, a lot of the other asset classes are definitely getting hit, and certainly hotels are the number one, unfortunately, that stands out to me that's probably having the largest effect at the moment.
Yeah, definitely. And I, on my brokerage business, I'm, getting a lot of clients that had sold a couple and, kind of told me a stories regarding that, the hotel asset side and how it's, of course, getting hit pretty hard. So moving on kind of to the sponsors, you talk to tons of sponsors being invested in all these different types of deals. What's your process of analyzing a sponsor to see if it's a good partnership to move forward or look at a potential deal and work with them?
Yeah, great question. So the short answer is that we don't have enough time. Those take hours for me to get into the real details. But I'll say that the really short answer is that the way that I approach investing is that I'm making a bet on a person, and my own one person's opinion is that who I'm making a bet on is even more important than the actual asset itself, with the asset being a very close second. I don't want to downplay the importance of the actual real estate asset you're investing in, but to me, who you're making a bet on is number one. And with that in mind, what I try to do is take both the business plan, a lot of conversations, in-person meeting, background checks, and other measures, and taking a look at data, numbers, as well as non-data in terms of how they speak, what types of, how the business plan is put together, how thorough is it, how conservative is even some of the writing in it in terms of and I can give you some examples, but in a nutshell, I'm trying to figure out if I'm making a bet on someone who's conservative, is looking to underpromise and overdeliver to build long-term relationships with investors, or if they're aggressive, trying to make the numbers look good for marketing purposes, may overpromise and underdeliver, but they don't really care as much because they have a good marketing machine to find more investors, et cetera. That's who I'm trying to stay away from, in a nutshell, as a philosophy. And when you consider the fact that I go into more conservative opportunities for more predictable cash flow, that's even more important, right? Because there's less leeway to potentially go, in terms of, for a construction deal, you may come in early, you may come in with higher rents than you expected. All these things, what I would say is outside of the control to an extent of the sponsor. And then it didn't really matter if they were underperforming, they may have been able to make up for it. It's much harder to make up for things when you're not really adding padding into a deal. So that's why it's even more important in the stuff that I'm investing in. So, absolutely. And I also look for sponsors who I definitely, how can I put this? I end up kind of on the same page with them from a personality perspective. I certainly try to avoid doing business with people that I just either don't agree with or just on the same philosophies. And there's no need for it. There's a lot of sponsors out there. So those are some very high level thoughts just to help. Hopefully it's helpful for your listeners. But we can get into more details if you want. Just getting into all the steps and everything else would take a long time.
Yeah, that's awesome. Again, like I said, you can go down and talk about this subject for a lot, because like I said, just very important decision when you're making that type of relationship. As far as people that are involved in investments currently, Can you kind of contest to the importance of communication, especially like during this time? Like right now, I'm dealing with a couple single tenant tenants, and right now some of them that are regional guys that are struggling in their marketplace. They have their kitchen areas shut down, so they're decreased amount of business. So deferred rent, that's a big thing right now. Can you talk about just them communicating the importance of that, especially now where things are kind of uncertain? We hopefully see the light at the end of the tunnel, but of course right now we kind of get over that hump. Can you kind of talk about communication with sponsors and passive investors?
Sure. Yeah. So, I'm going to break this down into two parts because I'm going to talk about general communication, what I would call like a normal time, and then the COVID communication, which has been different, honestly, with most operators. The general communication is really interesting because generally what I focus is on what I call non-institutional type of operators or sponsors who are not getting their money from pension funds and other foreign governments, et cetera. They're actually getting them from accredited investors, right? Like myself. And those non-institutional operators can be all across the board because they essentially choose what reporting they want to put out. An institutional investor often has to go with the guidelines of what their big investor wants and may need to cater a report to them. It's not like that when you've got, pooling a whole bunch of investors together. You can choose that. So the level of reporting, in my experience, and I've easily been in over 100 deals over the past 18 years, I need to recalculate things, but I'm probably still in over 70 LLCs right now, just to give you an idea. I'm hyper diversified as a strategy. So I'm making this point because I've seen a lot of reporting. And so I would say that if you're new to this space as a passive investor and you come from a buttoned up world of like consulting or, institutional type, work at a Fortune 500 company, which is where I was at the time, you have to bring your expectations down on reporting. And I think one really important thing you can do and ask when you're doing your due diligence is ask for a sample past quarterly report. Take a look at it and make sure that you're okay with it. Because I've seen many times where investors weren't okay with the level of reporting, which varies tremendously in detail, and could have just very easily asked for a previous sample report and decided if that was going to be okay for them. They just assumed that there was going to be a lot of detail, but there wasn't. So once you're in the deal, you're in the deal. It's a illiquid investment. You've got to put a lot of time into the due diligence upfront to make sure it's the right fit for you. And that's one of the things you should verify. So generally, I would say reporting is on average, okay to kind of like a little subpar. It's rare you get just amazing reporting, and it's rare that you get horrendous reporting, but that exists. I would say the most common is like kind of okay to a little subpar for someone that's really detailed like me. Okay. But what I've learned as well, which I think is a very, very important point, is I like to use the expression, I'd rather invest with the best operator with the worst documents and the worst reporting than the worst operator with the best documents and the best reporting. Now, I don't normally throw in the reporting piece. I did that for you today, but that's actually still true. It's all about execution. So I am comfortable giving some leeway on some reporting if someone's going to execute well, and I kind of get just barely enough data to make me comfortable. But other people may not be. It's very subjective. So if you're new out there, you definitely want to ask for sample reporting and just be cognizant of the fact that it may or may not be up to the standard you're looking for. That's kind of how this world works. As far as COVID-19 reporting goes, that is a different story. Most of the sponsors have proactively stepped up, in my experience, provided proactive updates, how they're managing the situation. And I think that one of the great things that we benefit from being pooled investors, and there's typically tens of investors that are pooled together, is that because of our sheer volume of people, I think what sponsors are doing are trying to get proactive and not have to deal with phone calls from concerned investors times 50, right? So it's their benefit to actually be proactive and to say, oh boy, I better put all these details out so I'm going to avoid questions, right? And I'm just making a guess. I've not asked any sponsors a question. I'm just reading between the lines here. So the reporting's actually been quite good. Some sponsors I've seen do weekly reporting and weekly updates, because we're now recording this in April. We just hit, April 1st was the big date that a lot of people are okay, what happens with the first month of rents now. So it's still in a kind of a critical phase. A lot of people are bracing now for May. So a lot of those sponsors are providing weekly reports. Some of them are providing more of a monthly report, whereas normally they do quarterly before. And there's the odd sponsor who's maybe probably going to do a report every month or two, but I'm not expecting most sponsors or hardly any sponsors to provide a typical quarterly report at this point. We're in a critical phase right now where everybody's trying to determine how much rents they're going to collect. Is there going to be a bigger problem? They're going to try, a lot of them are trying to negotiate with lenders, and they really need to keep investors apprised because of the challenges that are occurring. So that's really the right thing to do. And I think it's what pretty much the vast majority, if not all the sponsors are doing that I'm currently invested with.
Absolutely. And what do you think now, since with this crisis, because we learned a lot from the 2008 crisis, and we're always looking at historical data, and just moving forward as sponsors and investors. You think the underwriting is going to be more conservative? Of course, this is kind of like something we didn't expect to this level, but of course, a lot of people in the back of their mind, especially investors, are being more cautious because it is a scary time. Do you think that's going to be changing how people are, like you mentioned, the communications be more frequent, or putting more information out to make more investors at ease as we move forward as a society?
Yeah, great question. So it's very dangerous to make predictions, but I am going to predict a couple of things. Who knows if they'll actually come true? One is that what I find in previous cycles is that often towards the end of towards the end of the cycle we just had, if we agreed that the cycle ended, then there was a lot of funds that came up, and funds are more convenient for sponsors to run because they get to pool investors together into one entity and then go and buy multiple properties. It's just more efficient, right? Versus one and the next and the next. Typically what happens at the end of a cycle is that because it's harder for sponsors to raise money into a fund because the investors don't quite know what they're investing in quite as easily, that typically will change back to being more individual deals. So that's kind of prediction number one. Just what I'm only predicting it based on history. What normally happens is that you would go back to having more individual deals and less funds, and then towards the end of a cycle, you'll have more funds again. That's number one. Number two is that, let me ask you a question actually. Have you ever seen an opportunity ever that was put together by a sponsor that actually predicted a reduction in rents because of a recession? Have you ever seen that ever?
No.
Okay. I've actually seen it once, and it shocked me. And in fact, I had to call the sponsor and say, what is this negative? I figured it was something about the deal I didn't understand. And they're like, goes back to 2013. I think they projected the recession in 16 or 17. And they said, well, we think there's going to be a recession, and we just have to choose which date it was going to be. Keep in mind that the projections compound off each other, right? So if you have a 3% rent increase every year, if you keep going for 10 years, that's one thing. But if you interrupt it with a 5% reduction in rents and then keep going, that's a very different cash flow in year 6, 7, 8, 9, 10. So that's a very important point. I'm not saying sponsors are going to switch to that, but I do think they're going to have to ratchet down some of their projections for sure. And I would say especially on value add and construction opportunities. Now, in the stuff that I invest in, it's more stabilized. You're already looking for a very conservative sponsor. So I'm already hoping that it's not going to look overblown to begin with, but I expect more changes to happen in more value add opportunities, where now people may be pushing back on where rents may go and how quickly they're going to go there. When you think about a city like Denver, I'm just picking it at random, right? It was a really hot city, Seattle. I can go over some more in the past cycle where there were a lot of outsized increases in rents. Are you going to be able to convince investors that Denver is going to continue to grow at or even near the same pace anymore? Probably not, right? So you're going to have to ratchet back a lot of the assumptions, I believe, in some of the value add opportunities, maybe less so in stabilized stuff. And there's no doubt you're going to have to change the assumptions for an exit cap rate, depending on what you're paying right now and depending on when you buy that building.
Exactly. And even I was just thinking on the lending side as well, that, right now a lot of the banks are getting a lot tighter. Don't know how long or when that will change, but also that will, kind of change the numbers up. People probably have to come in, more conservative as well.
Yes, and I would imagine it's probably harder for someone to get a shorter term loan right now, like a construction loan or bridge loan. And even if they can, then they've got to be much more conservative about the debt they're going to have in 3 years, the access to liquidity, et cetera. It's tricky. So by definition, as we're just brainstorming through this, because I don't really do major value add, but if I'm thinking about it, the value add deals are probably not going to be as easy to close on and actually execute on based on less liquidity. So you may see as an investor less value add deals in the next 6 to 12 months. But I will say that my favorite time to invest in value add is actually at the beginning of a cycle. I kept telling people this. I was telling people, I only invest in value add at the beginning of a cycle. And what I meant by that is that you have much more runway left for things to go wrong, right? So if construction takes longer, and I kept telling these people in 2018 and 19, I'm like, I won't look at a value add deal right now. That pencils on paper at the time. In other words, it can make sense from a sponsor perspective for the projections and the type of returns investors are looking for. But then eventually the music stops at the end of a cycle, and then the runway stops. Whereas at the beginning of the cycle, you've got the momentum of increased rents going forward, most likely into a normal cycle. You've got the momentum of a lot of runway left, and that can help you to course correct if you veer off to the left on the runway, you can still get back to the middle and take off, right? So that value-add investing could be great as we begin another cycle, assuming you can find those types of opportunities. I'm not saying they're great today necessarily. I'm personally being very careful with anything I'm doing this year. But in the next couple of years, I think there'll be a lot of great opportunities, both in value add and non-value add, of course.
Absolutely. So, nowadays everyone's hunkered in their house. But I always ask all my guests, what's a typical work day, and do you have any special morning routines?
So here's a crazy thing. If I told you that my day has not changed hardly at all, I'm sure you probably don't get that from most people. I think the only difference in my day is that I work from home, and so now my kids are home. And my wife is a stay-at-home mom, so she was around a lot when I was working before, and she's just here the whole time. It's not much different. So what's really crazy to me is I typically have the type of schedule that's pre-booked, like for about 2 to 3 weeks, fully booked out, and just because of my size of my network. And I've probably only had maybe 4 call cancellations over a 4 or 5 week period the entire time. So the types of conversations change, but really not much has changed with my schedule. One thing I will say about my morning is that my morning routine is probably a lot different than a lot of people, in that as soon as I wake up, I'm on my phone and I'm reading economic data and news. And this is before COVID, and now, of course, even more so, for probably at least 1 to 2 hours before I even start my day. And that is just to, for me, I got to stay on top of the trends, what's happening, and just try to stay ahead of the curve. In the way that I invest, I have to try to think long-term, 5 or 10 years out, and also really understand what's going on with the economy, anticipation. So for example, believe it or not, since the beginning of January, I'd spent about an hour or 2 a day on researching the COVID-19 before anyone was really talking about it. And I was watching videos and reading articles that were non-mainstream whatsoever to understand what's going to happen, just in anticipation of like, okay, if I'm going to invest in something next month, do I have to worry about 2 months from now? And so I tend to do a ton of reading every day to try to get ahead of the curve on understanding what's coming up in the next 5 to 10 years.
Good. Would you mind sharing some of the reading sources that you use, or
sure.
may help others?
So I don't even vote, but I like Drudge Report, even though I know it's kind of biased towards one political affiliation, only because it's a really easy mainstream.
Yeah, got a lot of links. Yeah, it's easy to read. Yeah, definitely.
It's a nice aggregation. I like CNBC for the same reason, to an extent. And that, of course, also gives me an idea of the stock market sentiment and stuff. I haven't had a stock market investment since 2007, but it's important to understand what consumer sentiment, where that's heading. And then I take a look at something called Zero Hedge, which is 75% crazy negative biased and crazy articles you can definitely just not even read. But the other 25% is fantastic because they crunch a lot of data and get out of the weeds of the media and just get to a different level. These are ex-Wall Street guys, about, whether there's a jobs report. Well, what did they not tell you about the report that the mainstream media isn't discussing? And I can kind of get so many examples, but they just do a really good job of parsing through the data and looking at a lot of charts and data, which is so important. So that one's good, zerohedge.com. Calculatedriskblog.com is also really good. It's 100% data focused. All it is reporting on the general data that was released by the government or other sources every day. Now, I find that often they're a little bit optimistic in terms of their interpretation of that data, but they put some great charts together, linked to some other really good sites. That's calculatedriskblog.com.
Nice.
It's not that much verbiage, but a lot of charts, and it's just great to be able to look at. I take a look at a little bit at businessinsider.com as a portal, again, for a lot of different types of stories. The challenge I found that and it may just be me, but it's gotten very political in the past year, and the types of articles, they're kind of trying to like get more election involved, and I just want to read the data.
Exactly. Yeah. Same
so
way.
I don't go to there as much anymore, but it's still something that's interesting because it's a nice portal of information. What other ones are good? Those are the main ones I check every day. And honestly, when I add just those alone, if you're really going to read a lot of stories, that takes me an hour or 2 a day, easy. You can go to like Yahoo Finance, Drudge Report links off to a lot of good sources as well. Wall Street Journal, a lot of stories on there that gets linked off to for sure. CNBC is my favorite source right now for coronavirus live updates because they kind of tend to blend in general information with business information together, and they just have a really nice feed. So that's one I would definitely recommend for a kind of an ongoing live feed of business and coronavirus news as well.
Nice. Yeah, I appreciate you sharing that. Yeah,
Yep.
since I'm kind of similar where I work from home, and then my wife is a stay-at-home mom and everything. So we're used to being home together. But now with my, with the school canceled and my kids are home all the time, we've been able to kind of, whenever the day is nice. We're here in Connecticut. It's still in springtime. We have a lot of rainy season. We tend to take some walks and stuff. But now we're indoors more often. We're doing a lot of board games like Connect Four and
Yes.
things like that. Is there any special things that you're doing with the family since you guys are more indoors together now?
Well, we're in LA, so it's sunny here most days. We're very lucky, and we have for LA, we have a good sized backyard, which is not saying much, but so we're in the backyard. Like, we play in my backyard. I could play basketball, soccer, throw a ball like baseball. We played hockey the other day, and we literally just bought like a pickleball set that we just put the net, and we have like some concrete in the backyard, so actually able to play it. So we do a lot of that. This is all on the weekend. I don't play with the kids during the week because I'm around them and I'm here, but I'm just very busy. So
Hmm.
I definitely play with them after 6 p.m., but not like during the workday. We do a lot of board games. I'll tell you one thing we've done, which has been great, is I'm a big kind of fan of like old school comedy movies. So I'm talking about like Caddyshack, Waterboy,
Oh yeah.
Chandler, that kind of stuff, right?
Hmm.
And so we just started watching some movies with the kids. Our kids are 12 and 9 and they're boys. And so the last one we just watched was Waterboy. We just watched Big. We watched Nutty Professor. We have a whole bunch of them like on the slate. We watched Adam Sandler. What was the one with the golfing movie? I don't know if you've ever seen it.
Yeah. I
Um,
know what it is, but I
Happy
can't.
Gilmore.
Yeah, Happy Gilmore.
Happy
Yeah.
Gilmore. We watched another one he was in. We tried to watch where he was like going back to high school. I forget what that one was called, but the
Mm.
kids got a little bored with that one. But we've been trying to go through like a whole slew of like retro comedies, and they've been liking some of them. I love watching them again. So we're actually about to watch God, what's it called? Talladega Nights.
Mm.
I don't know if you've seen that one. It's
No,
a
I haven't
race
seen that one yet. No.
with Will Ferrell. Oh my God! If you ever
Oh,
go watch that,
yeah.
I'm a car guy, and it's just hilarious. It's about NASCAR driving, and it's just all comedy. So that's the number one thing that we've been doing just to supplement a little bit. And this is one more thing I'm going to share. My wife would cringe if she knew I was sharing this, but we've been trying to find stuff on YouTube on like streaming on the TV. And if you're desperate for content and you have a couple of kids at home and you can get into this, we just watched something called Marble Olympics, which is actually amazing production value by someone
Mm.
named Jelle. I think it's like Helle. I think it's a Dutch name, who literally puts on these Olympics with marbles that he puts together with crazy marble runs and sets in like 16 different events.
Oh
And
wow.
it sounds ridiculous, but if you pick a team and you're rooting for the team, it can actually be really. I mean, he literally does timing to 1/1000th of a second on the events. He
Mm.
has multiple camera angles, and it sounds ridiculous, but people out there should try it because it's hours of like to watch the Olympics is like 2 to 3 hours, and
Hmm.
he's done the Olympics for the last 4 years, and he's got other episodes too. And the production value is off the charts for what you would think you'd be watching. So we
Wow.
got into that. We were like rooting for our different Olympic teams, and it was a lot of fun. So that's another one if you're really desperate for content.
Well, yeah, well, everyone's at home. So, so everyone's like, looking for things to do. So I appreciate you adding that onto the list. My wife, we've been watching a lot of, like I said, old school stuff as well. But, we're watching a show called Outlander right now. She's into that thing right now. So, but yeah, it's good time connecting with the kids. And like I said, you're still getting your work in, which is good. We're learning about, investments and things like that, looking towards the future. So that's always a good thing. I know as we're hunkered down, things are changing again. We everyone hopes that everything's going to get better soon. But what can you say that you're most grateful for?
Um, wow, that's I'm grateful for a lot of things. Right now, I am extremely grateful to have my health. We've been very careful because my son actually had a virus himself when he was a year and a half that literally put him onto a ventilator. He almost died, and we were in the ICU for 2 weeks in LA. He had 2 surgeries. We were in the hospital for 2 months. So we've been through this kind of thing already. He was a few hours away from dying at one point. So we're very grateful for a lot of things, and I'm trying to be very, very careful with like I quarantine stuff that we get from Amazon for 2 weeks because of this. My son,
Hmm.
I am extremely grateful for cash flow. It has absolutely changed my life. I do not want to sound like an infomercial. That's not the point. But I tell you, like, I spent over 10 years in the corporate world with some amazing jobs. I have an MBA from the Wharton School. We didn't talk about that. And so, like, I went down, I had a good MBA, a really good corporate path. My last 2 jobs were at Disney and Toyota headquarters in LA. And I just knew that the corporate world wasn't the right fit for me the whole time, but I didn't know what to do. And I finally discovered it all. So, I mean, cash flow has just changed my life in so many positive ways. And while I say that I can't play with my kids till 6, and that's true, I'm still around them all day long. I can work from home. And this was before COVID, so I'm very, very fortunate for that. This is going to sound crazy because right now it's a very challenging time with real estate. But for me, I'm just very grateful that even real estate investing exists, because that's what created the cash flow opportunity for me to look for predictable cash flow. It's challenging right this second, but 99% of the time, when you go for stabilized opportunities, it's okay. So very grateful for that too. I can go on if you want, but
that's been great. And like I said, we really appreciate it. We've been following you for a long time. You said you have a very high reputation, like I said, as far as kind of like your insight of how you look at things and kind of your worldview on things. And that's just very helpful. And I really appreciate you sharing that with us. For people who want to, get into contact with you, have a discussion with you, is there any information that you're willing to share with us?
Absolutely. Yeah. So I'm happy to help anyone any way that I can. If you're new and you're just curious to learn more about this, I have 18 years experience, if that's helpful. If you're a more seasoned investor and want to network, I love networking with other investors, trade notes about sponsors, look at different opportunities together. If you're a sponsor, I'd like to talk to you too. I'm always looking for opportunities. And even if you're an investor group, another investor group, I love networking with those as well. So feel free to email me. My email is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com is the best way to reach me.
Awesome. Yeah, we'll make sure to have that in the show notes. Again, reach out if you just want to talk, sponsor or investor, just kind of start that conversation. Everyone's at home, so it's a good time to do that. Depending on when this is going to be aired, or which we plan on anticipating having that out pretty soon. But Jeremy, it was a pleasure having you on. Glad we was able to connect. Glad everyone's healthy. Look forward to your continued success, and we'll definitely be keeping in contact, and look forward to connecting with again soon.
It all sounds great. Thank you for having me on today. I just hope it was helpful for the listeners.
Absolutely. Again, be safe, and all the best to you and the family.
Thanks. You too.
All right. Take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.